What is the difference between accumulation value versus surrender value? I'm talking about on a life insurance policy, a permanent life insurance policy. My favorite is a properly structured, max funded, indexed universal life. And so if you're asking this question, it usually tells me that you've been studying an illustration or you're looking at somebody's annual statements. And so the question comes up, well, what's the difference between this accumulation value column and the surrender value column? I notice they equal each other after the first 10 years or 15 years. So tell me the difference. Get ready. I'm going to explain the difference, and it actually will be an advantage, not a disadvantage in the long haul. So I'm Doug Andrew. What do I know? Well, I've been a financial strategist, a retirement planning specialist now for 5 decades, helping thousands of Americans prepare for a comfortable retirement, to not outlive their money. My favorite financial vehicle to help them do that and be immune from the negative impact of taxes, inflation, and market volatility, which are the 3 big dangers that cause most people to outlive their money if they follow the herd and keep their money in IRAs or 401ks in the market, okay? And so I can knock the socks off of the majority of IRAs or 401ks by using max-funded IUL, performing strategic rollouts, not rollovers, rollouts out of IRAs or 401ks, get your money out of the market into a properly structured IUL. Now, when people begin to see the power behind this and they see illustrations or they start getting annual statements, many times they will ask this question. Well, I notice on this illustration, this proposal, or on my annual statements, there's this column of accumulation value or this number that shows my accumulation value. And then there's this number called the surrender value, which is less than the accumulation value number, okay? And so what's the difference? Okay, here we go. And I'm going to show you here, if you stay with me, why this is actually an advantage in the long run and why you don't need to worry about it if you're utilizing a max-funded IUL for long-range goals, okay? So basically, the accumulation value is the amount of money that is actually being credited with the growth or the indexing strategies, interest, dividends, whatever you're earning on your permanent life insurance policy. So the accumulation value is the amount of money there that is earning interest, okay? That is your actual accumulation value that's accumulating. And so then they can say, well, why is there another column that shows surrender value? Well, the surrender value is less, and those two values get closer and closer to equal each other on most policies by the 10th year. Some policies, it takes till the 15th year, and I'll explain why they are there. But basically, the surrender value only comes into play basically in 2 situations. The surrender value is the amount of money that if you totally canceled the policy, the insurance contract, and let your insurance coverage go, and you just wanted whatever money they would give you, the surrender value is the amount you would receive if you totally surrendered the policy, okay, for cash. And so the surrender value has a surrender fee or surrender charge during the early years of the policy. Why? Because the insurance company incurs substantial costs for you to acquire, for them to issue that policy, for you to acquire it. And those costs are administrative fees. They're costs in compensation to the licensed individual that helped you set it up, because you have to go through a licensed individual, okay? They don't work for nothing. And so you have the compensation to the licensed individual, you have the actual cost, administrative fees, and then you have what is called, mortality costs, the actual cost, the chance, the risk of if you die, okay? So if I started out an IUL policy and I'm 60 years old, and even if I put in $100,000 into an IUL policy, but I'm taking the least amount of insurance that I can get away with under TEFRA and DEFRA tax citations, because if you understand this from watching videos on my YouTube channel, IUL was designed first and foremost for living benefits. It's not to try to get, the most insurance for the cheapest premium. That's what you do if you need death benefit insurance. Here you're using it for living benefit. So you want the tax-free accumulation and tax-free income. So you take the least amount of insurance. If I'm 60 years old and I plan on funding this policy with $500,000, I can't put in all $500,000 all at once if I want to take out tax-free income. So I have to spread it out. So the very first year I could put in $10,000 and that covers all the costs of the insurance, okay? Or I could put in up to what is called the TAMRA premium, the maximum allowed, and that might be, let's say, $100,000. It doesn't matter if I put in $10,000 or $100,000, okay? The very first year, I'm only 20% funded if my intent is to put in $500,000 as soon as possible. I just can't put it in all at once because they passed a law back in 1988 under the Technical and Miscellaneous Revenue Act that slows the flow because the banks and brokerage firms lobbied Congress. They couldn't compete with these things, but they didn't want to kill them because this is where banks and credit unions put 30 to 40% of their tier one assets for liquidity and safety is in insurance companies, often in the form of BOLI, bank-owned life insurance. They own life insurance on people for the living benefits, okay? That's another topic. Let's get back to this example. You put in $10,000 or you put in $100,000, okay? Now, your intent is to get in $500,000 in the first 5 years. But if you put in, let's say, $100,000 and you happen to die, the insurance company is obligated to pay out $1 million because the minimum amount of insurance for a 60-year-old who wants to put in $500,000 is $1 million. Now, again, a 60-year-old could buy way more life insurance than that, than $1 million for $100,000 or for $500,000. That's not the objective. Okay. So if the insurance company has to shell out $1 million and you've only put in $10,000 or $100,000, that's a lot of money. So there is a cost for the chance of you dying. That's called a mortality cost. The actual chance or risk of you dying based upon your age. So if you're in your 60s, the chance that out of 1,000 60-year-olds in America, that probably about 30% of you will die the next year, then they have to cover that risk. Does that make sense? Okay. And so there's mortality costs that are associated with it. But if you put in 100,000 and you take out those costs, but if also the expense to set it up for you to acquire it and the compensation could be a grand total of $35,000. Okay. And so if you go cancel it, then you put in 100,000, the surrender value might only be $70,000. Okay. And so you say, well, where's the other 30 grand? Well, it's there. Your accumulation value could be as much as 90, 95,000, 100,000 after they subtract just the actual real cost there. Maybe the accumulation value, let's just say it's 90,000, but if you surrender it, you cancel it, they've got to recoup those other costs. So they may only give you a surrender value of 70,000. That only comes into play if you bail out and you cancel. Does that make sense? So 1 year into it, if you put in 100 grand in this example, maybe the accumulation value is 90 to 95,000, but the surrender value is only, 70,000. That difference is called the surrender charge. It only comes into play if you cancel. Now, if you put in 100 grand and you need some money and you want to go borrow, you could borrow probably up to 90, 93% of the surrender value. Okay. So if you have 70,000 of surrender value after you put in 100 grand, you could borrow 93% of that out of the policy with most carriers. And so the surrender value also is used when calculating how much can you borrow from the insurance company using that cash value as collateral. Okay. You could even withdraw it, but it's better to borrow it because then you can put it back. If you withdraw it, you can't put it all back according to IRS guidelines. Okay. That's another topic why you always want to use the borrowing or borrow your money. And sometimes people say, why would I borrow my own money? Because you can pay it back. You don't have to pay it back, but you can. If you withdraw it, you can't put it back, or at least all of it back. Okay. So the surrender value only comes into play If you totally bail out, you totally cancel, or it dictates how much money you could borrow from the insurance company using the cash value of your policy as collateral, okay? It also shows you what you could just withdraw out of the policy, which is really the dumb thing to do. And you can watch a video on the smart, dumb, and sad way to access money out of a policy, okay? Now, so the next year you put in $100,000, and now there's only going to be the cost in that year. And so now you put in $200,000, the surrender value is going to be probably around $170,000, $180,000. And you'll notice that the surrender value will begin to get closer and closer to the accumulation value. The surrender charges begin to be eliminated the longer that you own the policy and that you continue to fund it, okay? And so at the end of 5 years, you've put in, let's say, $500,000 in this example. The surrender value by that point will be usually in excess of $500,000, okay? If you totally canceled and bailed out, you'd probably get $500,000 plus maybe 10, 20, 30, 40,000 on top of that. But the actual accumulation value is even greater than that. But see, a lot of people are saying, well, I put in this much money. Where's my break even? That depends on how fast you're funding your IUL policy. Generally speaking, you'll break even if you're maximum funding it within 4 or 5 years, okay? Now, the point is this. You don't have to worry about surrender value unless you cancel, okay, which would be sort of dumb. If you think you're going to cancel it within the first 5 years, why are you even doing this in the first place? This is not a short-term investment. The biggest mistake people make is choosing long-term investments like this, okay, for short-term goals, where you're just going to put in money and take it all out in 3 years. Then this is not the vehicle to do that. You're having to jump through too many of these tax hoops, for different Tamra. It's not a short-term vehicle. It doesn't mean you can't access some money if you need it. But if your intent is to totally cancel, pull out all your money, don't start one in the first place. Hello? Because this is the long-term investment, 5 years or longer. Now, if you're worried about wanting to access 100% of the accumulation value with no surrender charge during the early years, you can do that. Most carriers, most insurance companies have a feature or a rider that you will pay for, and nothing's free, that allows you to be able to access, borrow, or if you cancel, you get 100% of the accumulation value. So they waive the surrender charges, okay? And that could be a waiver of surrender charge fee. Now, you can do that. There's a cost associated with it. And that cost, at the end of the day, usually eats into your net rate of return. If you've watched very many episodes of my channel, by diversifying and rebalancing, my rate of return average has been 11.17%. And our clients usually, at the end of the day, 20, 30 years down the road or longer, retroactive back to the first day they opened the policy, their internal rate of return is over 10%, 10.07 to be exact. So 10% in the rule of 72, their money doubles about every 7.2 years. So you can earn 11 and net 10, let's say, if you do this right. Now, if you chose a waiver of surrender and the fee on that allowed you to be able to access 100% during the early years and have no surrender charge, you might earn 11, but only net 9.5, okay? And what does that mean? It means that for every million you accumulate, instead of having 100,000 a year of tax-free income the rest of your life out of that, you might only have 95,000 of tax-free income. You say, well, that's within $5,000. Well, okay, but if you want to have the highest net spendable income and have the cheapest cost, then quit worrying about surrender charges because it's going to cost you over the long haul. There's a trade-off, but you can do it if you want 100% access to that money during the early years. But you're going to suffer on internal rate of return over the long haul. Instead of netting 10, you might only net 9.5. I'm just giving you an example of what it will cost you probably at the end of the day. There's going to be a difference, okay? And so what I usually tell people is, Don't worry about the surrender value. Normally, this will grow to equal and exceed equal the accumulation value, and then it's the same within 10 years. Some companies go 15 years, and the difference between surrender and accumulation value gets closer and closer when you study those illustrations. And so there's a reason for that, and that's so that the company can recoup its costs that they expended when they set up a policy for you. Now, that also leads me to another episode you ought to watch, because when people say, well, this is very expensive. No, it's one of the least expensive long-term goals that you could ever have. If you used an asset manager that was going to charge you 1%, and you invested $500,000 with an asset manager, and if they grew your money at a net rate of return of 10%, okay, $500,000 doubles to $1 million in 7.2 years. And in another 7.2 years, it goes to 2 million, and then to 4 million, and then to 8 million in about 30 years. Okay, well, you would have paid over 980,000 in fees to that asset manager if they were charging you just 1% a year on the value of your account, whether they made money or not. That's what asset managers do, and yet they have the audacity to say, "Oh, IUL is way expensive." No, IUL may be the expense or the compensation to a licensed agent during the time period you put in $500,000 was $30,000 one time. The IUL agent only gets compensated one time, or on the new money that goes in. They don't make one dime on any of the money that you're making. Okay, so would you rather pay a one-time fee of $30,000 over the first 5 years? And that's really the difference between surrender and accumulation value, basically. Or would you rather pay 1% or more every year on the value of that until the end of the day, and you're going to pay out $1 million in fees? Which one would you choose? I'd choose the one-time cost of $30,000. That's the surrender charge if you cancel early. So if this is the long-term goal, you don't ever have to worry about it. It actually will help you have a higher net internal rate of return, and it will end up being the most inexpensive retirement planning vehicle you could ever establish. Don't get hung up on the first year. Look at what it does over the long haul, and it will be one of the most inexpensive vehicles. The fees will be dwarfed by the amount of money you're earning tax-free on a property structured IUL. Okay. Now, you can learn more by claiming a free copy of my 300-page book, The Laser Fund. This has been flying off of our warehouse shelves, and I don't want you to miss out. It retails on Amazon for anywhere from $20 to $70. I'll gift you a copy free. And the way that you can claim your free copy is by simply going to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game, and I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy of this. This is actually 2 books in one, and I'll do it via priority mail. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you learn more by stories. You flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories of how property structured IUL is the dream solution to all kinds of goals, not only retirement, but college funding for your kids and grandkids, working capital for business, real estate management, emergency funds, estate planning, pension maximization if you're a school teacher, police officer, or firefighter. Also, strategic rollouts out of IRAs or 401ks, general tax reduction. And so claim your free copy. And when you're in there, if you like to listen and learn or watch and learn, there's audio and video formats available. But you can even schedule to attend a free educational webinar. On a weekly basis, we teach 90-minute webinars. They're free, no cost or obligation. On a monthly basis, we usually do a 6-hour educational event called Retire by Design. And you can also schedule an appointment to talk to a certified IUL specialist with no cost or obligation, so you can see how a property structured IUL can be set up for you in your particular set of circumstances, okay? And so it's very important that it's done correct, because I would say over 99% of insurance agents in America do not know how to structure an IUL to do what I've been talking about in this episode. So be sure and take advantage of this. Claim your free copy of the book, and I'll see you on the other side of your brighter future.